Hey everybody, welcome back to the channel. We are back with another episode of Daily Palantir. We've got two main things to talk about on today's show. Number one, NVIDIA smashes earnings. I don't even know if smash is the best word because they just demolish their numbers. We're going to talk about what that means in the context of Palantir, in the context of AI generally, and why Palantir is up 4% after hours because of NVIDIA. And number two, we've got to talk about dilution. Palantir's 10K came out yesterday. A lot of different things came out in that form. And as a result of that, there's some questions going on around dilution. What does it mean for share buybacks? Why is Palantir doing all this dilution? A lot to talk about. I had a lot of questions over the past couple of days come to me from people about this whole dilution issue. Let's get into it. Okay, first thing we'll do is NVIDIA. And I think we've got to do NVIDIA. This is what I'm looking at after hours on NVIDIA. As you can see right here, Palantir is up 4.93% right now, almost touching $24. It hit $24.10 at one point, but it's not $24.10 anymore, $23.86. It was down 2.82% of the day. At one point, it got to $22.30, end of the day at $22.74, now at $23.86. That was Palantir. And then if we go to NVIDIA, they are up right now 7.92%, basically 8%, $728. They hit a low of $674 for the day, ending the day at 2.85%. Now, why is NVIDIA up? What happened during their earnings? And ultimately, what does this mean for Palantir? First of all, I just got done listening to the earnings call, so thank you for everyone who joined that earnings live stream where we were listening to Jensen Huang talk about generative AI, accelerated computing, and everything that's happening. Essentially, and I know a lot of people already know this story, but his argument is that generative AI and what's happening with Gen AI is a bigger opportunity than the internet. And the reason he thinks this is the case is because every single industry, whether it's healthcare, pharmaceuticals, media and entertainment, obviously the semiconductor industry, you're looking at enterprise software, all of these different types of industries that exist, supply chains, logistics, like there's an infinite amount of industries that are going to need some type of GPU demand, either by training their own models to be able to implement enterprise AI, or there is going to be reliance on the hyperscalers, Amazon, Microsoft, Google, that are going to be using NVIDIA's chips in order to be able to get compute and demand and training models from them. So one way or another, whether you're a big bank that wants to implement AI to be able to remain competitive, or whether you're a movie studio that's using OpenAI Sora to be able to do text to video and to be able to generate the type of computational power that it takes to be able to make a 30-second video just from 5 different words, you are either going to need NVIDIA's GPUs or you're going to be relying on services that use NVIDIA's GPUs. NVIDIA has a monopoly on these GPUs, and they have all the pricing power in the world because they protected their monopoly with their intellectual property, and it doesn't seem like that's slowing down. That is what Jensen Huang said on the earnings call. Now, this is the only number you really need to see in regards to understanding what happened on the earnings call. Revenue is up 126% year over year, 26 billion to 60 billion. Insane. Operating income, 4 billion to 32 billion, up 681%. Net income, this is like bottom line profits. They did 4 billion last year, 4.3 billion. They did 29.7 billion. That's profits, not just revenue. That's up 581% year over year. Diluted earnings per share, $1.74, now $11.93. That's up 586% year over year. The craziest thing, this is the craziest thing. Their operating expenses are up 2%. They did 11.13 billion last year, 11.3 billion this year. For a tech company to only increase OpEx by 2%, and have every other single metric go up triple digits, and then they have their gross margins go from 56.9 to 72.7 in the course of 1 year is unheard of. NVIDIA is growing faster than their PE. They're growing double than their PE. Not only are they growing faster, they're growing double than their PE. Quarterly revenue, 22.1 billion. They beat 20 billion expectations, up 265% year over year. Data center revenue, 18.4 billion. That's up 409% year over year, 27% quarter over quarter. Full year revenue, 60.9 billion. Okay, so what does this mean for Palantir? Why is Palantir up 5%? Well, Palantir, whether we like it or not, is in the same bucket with NVIDIA when it comes to AI stocks. Now, the correlation between Palantir and NVIDIA is not the strongest argument in the world. The correlation to me is very simple. If companies need more GPU demand, that means they're training more models. Palantir has an AIP product. This is an artificial intelligence product that's growing 70% year over year in US commercial. The whole idea is to ontologize your data and then make it contextual to the nature of the organization so that users that are in the organization can get value from that data, whether it's in a hospital or whether it's in BP, that's trying to figure out, which oil drills they need to go into and how can you extract that data in a meaningful way. Foundry took that data, put it in one place, created a central operating system. AIP goes on top of Foundry and uses LLMs, which are using, at the end of the day, they're being trained by these GPUs to be able to contextualize that data and make it make sense to the organization. In order for that to scale, GPU demand also has to scale. Now, it's not a one-to-one correlation, but in general, if there is more demand from NVIDIA for their GPUs and for AI writ large across a variety of industries, there is a larger TAM for Palantir to go after those industries that are trying to implement something like a Foundry and AIP, much less governments across the world that are trying to implement something like a Foundry or AIP. So yes, it's not a perfect correlation, but there is a correlation. And then forget the technical correlation. The stock market doesn't care. I mean, I was watching a video yesterday of some lady on CNBC who said, she started just buying Palantir, buying Snowflake, buying this, buying that. And her justification was like, yeah, they're AI plays. And that was the extent of her justification. And I don't even blame her. At the end of the day, these fund managers, they don't have, 1,000 hours to do due diligence. They just need to know, is this an AI play or not? Is this going to be a secular trend? Is this going to move with the market? Because they're very short-sighted. That they're not trying to manage money for the next 5 years, really for the next 5 months. And if it's an AI play and NVIDIA crushes earnings, the argument is, and quite frankly, the algorithms that control the stock market are probably going to put all these things in a bucket, and these companies are going to go up even if they don't necessarily get a benefit just from NVIDIA going higher. And that is why Palantir right now is up 4.84% after hours. Now, here's the question. Is this sustainable? I don't know. And this is what I was tweeting about earlier today. Twitter can be in the description. You can check out this tweet I had. Let me pull it up right here. My tweet was that, yes, these numbers are unreal. They don't make any sense. I mean, they make sense, but sometimes you can't even believe them as you're looking at them. But the market's at an all-time high. S&P is at an all-time high, and QQQ is at an all-time high. So how could you ignore something growing double its PE, but inflation isn't fully gone yet? We got the Fed minutes today that basically said inflation is still a little bit of an issue, and we're likely not going to be cutting anytime soon. So July probably is the earliest. May, maybe, but more likely July for that rate cut. So the next few months in the stock market are going to be some of the most interesting times in the market as investors have to deal with sticky inflation, right? This is a concern that's not going away, and it's going to keep rates high. But the opportunity of a lifetime is AI. And so what I expect to happen tomorrow, I'm making this video before the day before NVIDIA earnings hits the pre-markets tomorrow, and we'll see what ends up happening, is I think they're going to get price targets out the wazoo. They gave amazing guidance. They guided for $24 billion next quarter. The street thought $22 billion. They guided $2 billion above what the street expected. It's just insane. I think the street's going to upgrade the stock. I don't know if the street's going to buy the stock. I would imagine this thing is not going to sell off. That is my prediction, but anything can happen. The market's at an all-time high. If the market wants to take a 5-6% pullback and just take a little bit of a breather, I don't think that would be insane. I think all of us would be like, that's pretty reasonable. But NVIDIA is not stopping its growth. And if NVIDIA is not stopping its growth, and that means Palantir is not stopping their growth, is there a need to take a break in the markets in the conventional sense like we've been thinking about for the past, many years about what happens with investing if we are going through a revolution that is the AI space, that is, the next coming of the internet, maybe even bigger than the internet? I think over the next couple of months, we're going to see what happens. But so far, the numbers are there to justify this. Even Palantir's numbers, they're not NVIDIA blowout numbers, but they're still pretty damn amazing numbers at a time where interest rates are the highest they've ever been. That's the other thing about NVIDIA. They did this with 5.5% interest rates. It doesn't matter for interest rates because their demand is unlimited. And they're profitable. Palantir pivoted to become profitable during these high interest rates and is still able to put up some of the numbers that they're putting up. So I think over the next couple of weeks, we're going to see what happens. NVIDIA crushes their numbers. This helps Palantir. We'll see if this is sustainable tomorrow. But so far, I think we can all say AI is not a bubble. These numbers do not feel like we're eating bubblegum. These numbers just feel like an S-curve is getting started, and that's going to affect a lot of companies in the world, including Palantir. All right, next thing we got to talk about is dilution. This has been a big topic since Palantir's SEC filings came out yesterday. And we're going to go through it step by step, and hopefully I can clear up the concerns a lot of people have. Because I don't think this is the biggest deal in the world, quite frankly. But also I can give my perspective on how I think about, what's going on with dilution. So here we go. This is what was shown yesterday. As you can see right here, this is from a 2020 equity incentive plan. Essentially, think of it as stock-based compensation. That's the nature of why they're even doing this. And they have the ability to issue 250 million more shares. This was said in 2020, so this can't really be a surprise to people. If people didn't read these forms, then it might be a surprise, but this was the case. And they are, as of January 1st, 2024, Palantir, issuing 110 million shares, or they have the ability to issue these 110 million shares starting January 1st, 2024. Now, there's some technicalities on what price they're going to issue these shares at and things like that I'm going deeper into, and we'll talk about that in future episodes. But that is the overall sort of big news when it comes to dilution. Now, a lot of people got upset about this. They weren't exactly happy. Here's my thoughts on what had happened and why ultimately this really isn't that big of a deal. So this wasn't really a surprise, and it's a part of a plan set in 2020, and investors, can't really be like, oh, this caught me off guard. It's like, well, they said they were going to do this in 2020, and now it's starting to get executed. Number two, we need to issue stock not to raise capital, but to pay for stock-based compensation. I think that's a really important point. We are not issuing stock to be able to pay for the lights, or to pay for, to pay for some random stuff that we don't know how to finance. This is a company that has $3.7 billion in cash. It's not about having money. It's about issuing stock to employees so that they're motivated to be able to stay at the company. Stock-based compensation is 22% of revenues. It used to be 70%, so it's come down significantly. And now here's the kicker. Stock-based compensation is worthless, with many exclamation points, if the stock doesn't go up. So this is not some reckless spending, in my opinion, using shareholder capital. This is more so, hey, we need the best talent in the world. They need stock to be motivated. They're not going to leave Amazon, Microsoft, Google, where they're getting $700,000 a year plus equity to come to Palantir, if they don't have any equity, or they don't have any meaningful equity to be motivated enough to stay, right? At the end of the day, human nature requires some type of money incentive. They're not going to stay unless the stock goes up, so we're all aligned on getting this company to perform. Essentially, people will not join the company if they don't have incentives. They're not going to stay at the company if those incentives don't keep them incentivized, i.e. the stock going up. So to say that, you're diluting shareholders by issuing all these shares to pay for stock-based compensation, not to pay off your debt because you don't have any debt, to me, the question is, do you believe in stock-based compensation? And we'll talk about that in a second, but I think stock-based compensation is not the worst thing in the world to pay for, which is why this dilution to me is not the biggest deal. In order for the company to perform, aka grow massively, you need the best talent. Growth solves all. If AIP demand is off the charts, in the words of Karp, which is what he said on the earnings call, then SBC will be going to talent to capitalize on that demand and hopefully get closer to the 30% CAGR we all know Palantir can eventually get to. This money is not going to random things. This money is going to employees, aka the smartest engineers in the world that are begging to work at Palantir. Karp saying they're getting bombarded by applications every day because they don't want to work at these other companies. They want to work at Palantir, but they need to be motivated to stay at Palantir, and that's where SBC comes in. The point is, you have a company that's so attractive enough that you're getting some of the best talent in the world that actually want to stay in the company. In summary, we need the best talent. They need stock. They won't stay if the company's stock doesn't go up. So even with dilution, the idea is to grow fast enough so that the dilution does not become a concern long term. And to do that, you really need the best talent to grow. This stock-based compensation is not going to salespeople sitting in a cubicle trying to sell Palantir on LinkedIn leads, right? It's going to engineers that are leading boot camps with some of the most sophisticated companies in the world, showing off some of the most sophisticated software in the world. And that's why we're issuing these new shares. So in my opinion, does dilution suck? Sure. Did the company tell us they were going to do dilution 3 years ago? Yes. It's not like this came out of the blue. So that's the first thing. Number two, if the dilution is going to pay off some random stuff, like private jets or whatever, or debt, then yeah, you would be annoyed. But if the dilution is going to employees think about this as I've said this before, but think about this as a shareholder. The people that graduated from Harvard, MIT, all these, all these advanced PhDs in computer science and all this stuff, they're working for you as a shareholder. You're not working for them. They're working to make sure your stock goes up so that you can have shareholder appreciation. And they're obviously incentivized as well to get the stock to go up because they got stock-based compensation. So in my opinion, this is not the worst dilution in the world. This is dilution that's actually necessary. It's a dilution that we knew was going to happen. And every company, whether you look at NVIDIA or Amazon or Tesla, if you just look at their shares outstanding, it goes up over time because they have to issue shares to make sure employees are incentivized. But the reason these tech companies have share appreciation at such a phenomenal level is because they grow fast, because they have the best talent, and the fast pacing growth leads Wall Street to then buy up the stock because there's not that many companies in the world that grow really fast. There's not that many assets that grow compounded year over year. And so the idea is if you have the best talent in the world, they will help you grow, and then Wall Street won't really care that much about dilution because ultimately where are they going to put their money? They're going to put their money in the companies that grow. So to me, that is why the concerns around dilution from my perspective are not the biggest deal in the world. Now, let's talk about buybacks. A lot of people have been saying, how could they promise $1 billion of buybacks, but they're not going to be, but now they're issuing 110 million shares. And if you do, $1 billion divided by 23, which is the current share price, then that's only 43 million shares. So you're only taking 43 million shares off the table. Like that's not that exciting. Well, in my opinion, I don't think Palantir ever had plans to do a buyback. Quite frankly, you got to remember when the stock was $20 in August of 2023 on their Q3 earnings, which at that time $20 was an insane valuation for a company that reported 13% year-over-year growth. It just didn't make any sense. I think Palantir knew in order to save the stock from being decimated that day, because if they didn't really have any good news, then 13% year-over-year growth was not good news. Yeah, they were GAAP profitable again, but at the end of the day, like, you really need to show something good to Wall Street. They said, okay, we'll buy back $1 billion worth of shares. And I think Wall Street at that time was like, all right, well, that's good. That means you think you're undervalued, you think growth is coming, you think there's like a floor to the stock, and then boom, like that's a good reason to like do a share buyback. The stock fell to $13.80 after that. In the next like 2 months, there were no buybacks that were done. We didn't get any buybacks. From $13.80 to what? $18.50 at the top. We did not get any buybacks. So if we didn't get any buybacks at those levels, I think Palantir themselves realized two things. Number one, maybe for the growth they're putting up, their valuation is a little stretched. Now, the street can think whatever the street wants, right? The street is totally different from internally the company, but maybe they felt that it was not good to sit on that capital because they didn't know what the street would do. And if they, report their numbers and the street took them up 40%, if the street took them down 20% and they're sitting on a negative 20% on that money, I quite frankly would be pretty pissed off if they bought the stock at $16 and the stock would be at $14. And again, they don't know where the stock is going to go. The street ended up liking it, but they didn't know that. And if they're sitting on that stock that they bought at 16 with $1 billion, and now the stock's at $14, you're underwater on those shares. And here's the real thing that would have hurt badly. Now that $1 billion cannot generate net interest income for the company to remain GAAP profitable. Remember, part of the reason we've remained GAAP profitable, yes, the income from operations has gone up and we would be profitable even without the net interest income. But when you have $3 billion generating 5% every 3 months, yeah, that adds a little bit of money. And that allows your EPS to still go higher, which is what the street wants to see. And so in my opinion, buying back the stock right now at $23 would make no sense. Number one, because you just issued 110 million shares. So even if you bought back $1 billion worth of shares, that's 43 million shares. That's not even half of the new shares you just diluted shareholders by. So that doesn't make any sense. Number two, if you didn't buy back your stock at 16, why would you buy back your stock at 23? Like either wait for it to pull back that much, maybe that doesn't happen, or wait till the company really consolidates, like for the next 7 months in this $22 to $25 range, to the point where you are super confident that buying back at this level is like definitely undervalued and that it's not going to have a massive swing to the downside, because we still don't know if we're out of the $17 to $19 park yet. It's been 2 weeks, but I think we need a couple months to fully confirm that. And then finally, collect your 5%. 5.5% from treasury bills. Like, why would you, like, if you have a bad quarter or things aren't necessarily the best, or maybe the net income doesn't necessarily go as high as you want it to be from income from operations, at least you have 30 to 40 million bucks coming from your cash pile that's growing if it's in T-bills, and you're getting that cash to be able to support your operations and increase your EPS. So I don't think the buybacks make any sense at this point. Unless we get a massive pullback, I am not a proponent of the buybacks, and I would love to know what you guys think in the chat. Logically speaking, does it make sense to buy back 43 million shares when you're issuing 110 million? Not really, especially when there's enough liquidity to buy up those shares. We know the demand for Palantir shares are high. They're getting bought up. So do you really need to take a bunch of shares off the market just for shareholders, especially when that money could be generating you income that goes down to the bottom line, and that at least helps when it comes to GAAP profitability, especially as the government business has stagnated. We need that to reaccelerate. Until that reaccelerates, we're not going to have top line growth of 30%. And so you need time. And if your cash pile can get you some income while we're waiting for that to happen, I don't think that's the biggest deal in the world. So overall thoughts, I don't think dilution is that big of a deal because stock-based compensation is very important. Number two, I think buying back shares wouldn't make any sense right now if you didn't buy them back when you were in the $14 to $18 range. And now we just have to see if we can consolidate at this range over the next 7 months before I think Palantir feels confident to buy back their own stock. So those are my thoughts. Let me know what you guys think. Thank you guys for listening and watching. NVIDIA crushed it. We'll see what happens with Palantir. Palantir's up about 4% because NVIDIA crushed it. And in terms of dilution, I think stock-based compensation is a reasonable reason to dilute shareholders. And I don't think buying back the stock right now would be that important. But let me know if you disagree. Let me know your thoughts in the comments and what you guys think. Thank you guys for listening and watching. DailyPalantir.substack.com, my newsletter every single day. Newsletter comes out about 11 p.m. Eastern Standard Time. Please make sure to subscribe to that. It's free to subscribe. And I'll see you guys in the next one.